everybody, meet Megan Munley. She's with
Hi.
Guild Mortgage. She is one of our preferred lenders. So we want to bring her on and get her perspective.
That kind of brings us to what we were talking about today. When we're thinking about buying in a market right now, if we've got these major geopolitical concerns, World War III, if we've got something going on with Middle East conflicts, what does that mean for somebody that's buying a house right now?
And people don't feel safe, they don't spend.
Home prices are what has made things unaffordable. It's just that if you were to fix that problem drastically, people would lose money on their homes and then they wouldn't be selling them. Again, because Megan also follows the same philosophy of she doesn't let people lend recklessly either, or borrow recklessly, I guess you should say.
I think it's important. We've got to find what that comfort range is, and also being able to share that with clients, not just because that's what I can determine on what I look at from your gross income and your take-home pay, but realistically, how does it feel to you?
So as per usual, for how we start any podcast episode, we pretty much start talking about the podcast episode for all the meat and potatoes in the podcast episode, and we say, screw it, hit record. So we're back. Moving sucks.
Well, Meg was giving out all the golden nuggets.
Yeah, I know. And I said, you know what? This sounds like something really great to say on the podcast. So everybody, meet Megan Munley. She's
Hi.
with Guild Mortgage. She is one of our preferred lenders, and a wildly successful one at that. So we want to bring her on and get her perspective. And before we invited her to come on, it was really going to be about, the fun 20% down, or how to save your money to be able to buy a house or to be able to invest. But then we had some current events happen over the weekend. Not sure if anybody heard that we may or may not be entering into a World War III, just some light casual current events over the weekend. So Megan had sent Seth and I something fairly interesting last night, just about the trends and just things that have happened as it pertains to lending historically, as it
during times of
Global.
geopolitical uncertainty, we will call it.
Yeah, that's a good way of putting it.
Before we get into that, though, let's let Meg tee it up. A little background: where you're from, what you do, how you do it, your philosophy. Just give us a little
Social security number, blood type, favorite
Social
color,
security number.
house street you grew up on.
Can give it all to you. So I'm originally from Philadelphia, born and raised. I am actually first generation American. So my dad came over from Ireland, grew up throughout Philly, went to a pretty cool college Seth might know the name of, down in Baltimore, Maryland. So Loyola College until it became Loyola University. And so got into the mortgage industry at a really interesting time, right around 2010, exactly when everybody thought it would be a great time to flock into the mortgage industry, kind of similar to the
similar to when I got licensed in real estate. Let's get into real estate at the craziest time possible. And you said, you know what I think would be a great idea? Lending.
Yeah. I mean, it was a really interesting space to be in. Obviously, we were coming out of the recession at that stage, and really jobs were super low. Had an incredible opportunity to learn alongside my mentor, and really get into this industry, which I didn't realize was going to be as much fun as it actually is. Because at the end of the day, what we get to do is help people make these crazy big financial decisions that really help for their security, for their family, for their wealth long term. And it gets to actually be really fun to hold someone's hand alongside that. So not at all what you might picture when you're 5 years old and someone asks, hey, what do you want to do with your life? But it's a really cool job that I get to do on a daily basis. And I'm really grateful for it every day.
And you said something at settlement, 2 weeks ago? And I was like, oh, I would never want your job. And you're like, I really like my job. I like doing this. And I was like, I really love that you love doing that, because I could not be the one who's sitting behind a computer screen and putting together all these numbers and running all these I love the out and about. I love my side of things. I love what I do. And I was like, it's so great to have that partner in this whole team that people need who love what they do and who are so great at and passionate about what they do. So
it's so true, because I think what ends up happening is when you're thinking about buying a house, there's all those anxieties and the fears that come up with it, because it's a really big deal. It's one of the largest financial decisions someone's probably going to make in their entire lifetime. And so when all those fears come up and all those anxieties and how do you make the numbers work, I get to take all those puzzle pieces and put them together. And so sometimes they're not always going to be clear cut and dry, and we've got to figure out what can we move, what can we lever in order to make it work. But when it all comes together and when you start to see the shoulders drop and you start to see someone get excited about the process, like that entirely changes the game. And then it makes it so much easier when you're out looking at homes with people that they're going to be excited about it and not feel so stressed. And so I think that kind of brings us to what we were talking about today. When we're thinking about buying in a market right now, if we've got these major geopolitical concerns, World War III, if we've got something going on with Middle East conflicts, what does that mean for somebody that's buying a house right now?
And how do we lower the shoulders?
How do we lower the shoulders?
So we have Megan Munley here today to lower the shoulders.
That's right.
Of the consumer.
And one of the many reasons that we work with Meg is because she shares our philosophy, which is collecting as much information and like getting the financial piece squared away. So when you do go out and look for homes, you can actually look at the house and not worry about, and it's not even like a conscious thing, but if you still don't have clarity on the lending side and all the numbers, it's always going to be kind of in the back of your mind. Can I afford this? I don't know how much the payment is. I don't know this, that, or the other. So that's one of the reasons Meg works with us, is because we have the same process. And, whether they're staring down the some student loans or World War III, it is our job to get the shoulders to drop it, so to speak. I like that analogy too, because it's very true. You can just see when people kind of just like power down on a call. And that is one of the reasons that we always, when we onboard clients, we always do it on Zoom, because it's important to have that eye contact. But I guess the question now, though, Megan, is like, since you're in that lending world, is what is the chatter saying about this aggression? By the way, I don't think we've actually explicitly said it, but we decided to bomb 3 nuclear facilities in Iran on Saturday. I think that
I didn't do nothing.
Well, we're all Americans, Jen. And in the end, obviously Saturdays is a great day to do it because, most people aren't paying attention to the news and then the markets can't react. But now that it's, I guess, Monday morning, what's the chatter in the lending world about this?
Yeah. So when it comes to geopolitical concerns, if we take like a bigger standpoint first, when it comes to geopolitical concerns, what ends up happening is you have 2 buckets that are going to happen with investors, right? So your mortgage-backed securities come from bonds, right? And then in the other bucket is going to be the general market, the stocks, right? So when you have these geopolitical concerns, the biggest or the initial reaction you often see is what's called a flight to quality or a flight to security. So investors are going to look to park money in places that are going to have security. And so bonds and treasuries have a long, stable security. And so with that actually ends up helping to drop interest rates initially. So what we're starting to see already this morning, it's Monday morning as we record this, as we are seeing right now in the bond market, we are seeing that the cost of bonds are going down. So that's going to create lower interest rates in the short term. The question then begs, what does this look like in the future, right? So right now, this may start to bring mortgage interest rates down in the short term. But then when we look out further, the question is, what can happen in times of war, right? What can happen with interest rates? And historically, we can actually check and see, looking back in other conflicts, how that has impacted the markets. And so what is actually going to be the bigger question is, what does it do to inflation? Inflation is entirely why these mortgage interest rates are as high as they are right now, because that has just gotten out of control over the last couple years. And it's starting to come back down. But if the government is doing a lot of spending when it comes to war, if oil prices are going to go up drastically, then that's going to cause inflationary pressure. And long term, that could actually start to see interest rates moving higher. So the question isn't going to see this major difference as of right now. It seems like oil prices haven't gone up all that much this morning. So it's really going to come down to what is going to happen with oil. And as we start to see the treasury markets picking up throughout the day, right now we're starting to see that there's pressure to bring interest rates down.
Yeah, and I would add some texture to that. The reason that Megan is talking about oil is because 32% of the world's oil comes out of the Strait. It has to go through the Strait, what's called the Strait of Hormuz, which is a very small amount of waterway. It's like the Strait of Gibraltar between Morocco and Spain, where if you control that, you control the flow of resources in and out of that. And Iran has indicated that they are going to mine and shut that down, and that means all the oil from Iraq and Kuwait and all the other Gulf states, it could be constricted. If there's not access to that oil with scarcity, prices go up. The other thing that the Fed, with the interest rates, the Fed is only in charge of two things: it's monitoring inflation and unemployment. So not only do we have high inflation because, not only do we have higher rates because inflation is a concern, but also because the joblessness claims, or the job claims, has been relatively strong. Yeah. So, the way I look at interest rates is that it's like a governor on the economy. If money is out of control and people are spending money like crazy, they have to raise interest rates to make it actually, like, to kind of kill the economy slowly. And when, the market starts to slow and inflation comes down, they lower rates to incentivize people to invest, borrow money, and speed things up. And it's this like fine balance. So during COVID, everyone thought the entire market was going to eat itself and collapse and nobody was going to do any business at all. So they just dropped their rates all the way to the floor. I would argue they did it for too long. But I do get that question.
Thing that could have happened.
I do get that question a lot of times, like why are these rates like where they're at? And I was like, the flow of money has run unabated, and I think it's been almost a slingshot effect. And Jen was with me in 2021, where I kept saying they are keeping these rates way too long. They refinanced everybody down into these low rates, but also it created this slingshot effect where then the economy went bonkers. So in a war scenario, though, I'm thinking more along the lines of, yes, you could have a constriction of oil supply, and yes, you could have inflation fueled by military spending and all that. But on the opposite side of that, you have buyer sentiment. The people don't feel safe, they don't spend.
Yeah.
So I think that lends itself to maybe some real world kind of analysis as to like why interest rates might not go way up or way down, because you have that kind of push pull.
That's kind of what I was like. So I started touching on that when we were all talking last night, is like, I kind of think that rates, if anything, may drop slightly and not drastically, but only for the sake of like people will be too fearful, or the inflation will go too high that they won't be spending money out into the marketplace, and that they will need to put more money into people's pockets to be able to put more out into the economy.
And what's interesting is, remember, rates can really only move in two ways, right? So mortgage rates are only going to be moving based on market activity. So how many buyers are coming in to purchase those bonds, right? Or the Federal Reserve. And the Federal Reserve, like you said, Seth, they do not have to look at market sentiment and buyer sentiment to decide whether or not they're going to be lowering rates. They're looking to see where's inflation and where's unemployment. Mm-hmm. So unless unemployment really starts to show up in the data that they're looking at, no matter what a president or no matter what your FHFA chairman says, when it comes to the actual Federal Reserve, they are a completely separate governing body. So they don't have to just lower rates because that's going to increase buyer sentiment. That's not how it operates.
Yeah.
I would love to have a conversation with them. Just be like, can you please? Like, you think a please would do anything? Because I'd give it my best please.
Well, listen.
And again, and actually, something that you said that I don't think people realize when everybody wants a crashing market, like I want the market to crash so I can buy a house for $1,500 again. Is what you said is unemployment. Like unemployment needs to go up for rates to drop, and I think that's what people don't tend to forget a little bit. Is
It's not exactly a good thing if unemployment is going up. That's going to be way worse for the economy. And then that's really getting into recessionary lines. And like Seth said, it's a really important balance that the mortgage rates have to help temper prices as much as they can. Because if we look at how mortgage rates really are historically, right? If we go back over the last 30, 40 years, over 7% is the average. So just because the 2010s saw those rates well below that mark, that doesn't mean that's a normal market in any way, shape, or form.
Yeah, I've actually, to be candid, I've always taken issue with that average long-term interest rate metric because it does not, in a vacuum, yes, it does not take into account income to house price ratio.
Right.
Yeah.
The housing affordability is very much upside down, and we've talked about that on this podcast. And I would argue one of our core reasons for making this podcast is because home affordability is not great. Interest rates can be kind of whatever they want to be, but the interest rate actually is. I actually would argue that the interest rate is not what's killing affordability. I think Jen and I don't agree on this. That is not the problem. The problem is that a lot of these houses are just really expensive. And income has, in 1973, income departed goods and services in this country, meaning it stopped keeping up.
Yeah.
And, you add 45 years, 40, 50 years of that, throw in a pandemic, throw in a Great Recession, and that has only exacerbated the disparity between income and price of goods and services. The interest rate, I think, is just more of a feature than anything.
To go on record to say, I do not disagree with that. I agree wholeheartedly with that. And it's more so the fact of, okay, well, things are what they are now. And I mean, if we go into a total, lower all the home prices, then we're going to have a lot of people who are going to be upside down in their homes. And that's going to be its own set of problems. It's more so interest rates are at least a controllable factor that can at least have something to do to offset the practically doubled pricing of homes over the past even 5 years. So it's not that I don't agree that home prices are what has made things unaffordable. It's just that if you were to fix that problem drastically, people would lose money on their homes and then they wouldn't be selling them.
And to be honest, can that really be fixed, right? Because we have such a shortage of homes right now in terms of the entire country. But could we even pare that down even into our specific area?
You have to, because there's no shortage elsewhere. I mean, that's the Sun Belt is filled with homes. I mean, they're just still building homes in Florida. I mean, Jen was just down there. She's like, who the hell is going to live in all these homes? There's just construction site and crane after crane. We would definitely
Jurassic Park of heavy machinery.
Talk about housing shortage. We'd have to get hyper local on certain metropolitans in the country and then the Northeast.
Yeah. And it's where employment is strong, right? So employment is strong. And we also just have a shortage that's in terms of housing. So when it comes to the actual home prices, unless you're starting to see a flip in terms of the number of homes that are available for sale, they're going to stay stable where they are.
Yeah, well, I mean, we're pretty well. Jen is very bullish on the idea that home values will never not come down just due to the housing shortage. I think it's a valid supply and demand argument. I mean, it's one of the oldest economic principles in history. So I think there's validity to it. But I think that the housing market's a little more nuanced than that. I think that there's an opportunity even within our local market that there are areas that are going to see price reductions, and then there's areas that are just never going to. I mean, you look at and then you stratify it across
The nation.
market segments. Like luxury is definitely going to see a bigger hit than something that everybody wants, which is a $350,000 detached home somewhere.
Everybody.
Everybody
Everybody
wants
wants
that
it.
three hundred fifty
That
thousand
is
dollars attached home, and so I think that there's an opportunity though, and I try to bring national statistics into my business, into the team, into this podcast because we don't have to imagine. There are lessons all across the country of how a housing market can operate, even if there's like a slight tilt. It doesn't have to be Texas or Florida, but even like North Carolina, where in Raleigh, outside of Raleigh, they started building too much, and now it's like market's slowing down. How those markets react, how those agents, how those consumers react can speak to all about how we might have to in 6 to 12 months. And that's why I take such a high interest, because I'm all about being prepared. But this like Iranian thing is like a total, outlier event that can create
better choice of words than what I was about to say. That probably.
What were you going to say, Jen? Just I can tell you, you're all muzzled.
There's a total bomb in things, but that's probably not the best choice of words under the
yeah. That would be on. Yeah, I mean, it would be actually apropos. It'd be appropriate, but
we'll keep it in.
Yeah,
we'll get canceled. It's fine.
Yeah, we're not going to get canceled over this.
Get canceled for being insensitive. It's fine. Oh, somebody saying something in a comment. She's so insensitive.
No. I mean, but I think that the larger, longer arc of the market is, in the Philadelphia market. I think we're kind of lucky because we get to go last. We go last during all these economic cycles. Our market reacts last because I think we have probably the best mix of factors, which is jobs, diversity, cost. I mean, Philadelphia, especially the ratio between salary and home values, and then you add in taxes, like that mix is really good. Like you go to other cities, it is not great. You can get great salaries, but the price of houses is through the roof and they tax the hell out of you.
Philadelphia's transfer tax just went up again, though. I would just like to make note.
Yeah, they're trying to raise like $6 billion for something, and I fear that it's a drop in the bucket, and half of it will probably go into corrupt hands somewhere. It'll get leaked out somewhere.
Shocker.
But no, I mean, so let me ask you this: when you went back and looked, Meg, at like historically, like what happened in certain war, like what happened in 9/11, like what happened to rates? Because we were just coming out of the .com bubble. So like what happened then?
So when we go back, right, and if we actually look at what happened during that period of time, that's when ultimately rates started to kind of come down, but then increased again, right? So if we look back specifically at that whole Iraq war era, that's where interest rates historically were sitting right around that like 6% range.
Yeah.
But then when you look at that trend to where rates were at that time, that was really just kind of a little blip down before they started to increase, because that got a lot longer than exactly maybe what we had expected was going to happen. Maybe we didn't think that was going to be a long-term conflict that we were going to be involved in.
Well, so our leaders told us it was going to be like, yeah, we're going to like pop over to Afghanistan. We're going to be in and out. Bada bing, bada boom. And in 19 years
sounds
later,
familiar.
And $3.5 trillion later, here we are sitting on the other end of an Afghanistan pullout. So I think also like things get lost in the sauce. I think the buyer sentiment, but also just kind of government spending, and it's just kind of the cost of doing business. So I think interest rates probably kind of moderate just because it becomes like the new normal. But in the end, like I don't know if there would be some massive military spending increase with this Iranian thing, because I actually don't foresee like American boots on the ground. Like I see it as a proxy war where, America and China and Russia on the other side, we're pulling the strings behind it, but Iran and Israel are it's the same thing that's happening in Ukraine.
Right.
Ukraine is not a country that can defend itself against Russia, and Russia has had some hard knocks, and China is backing them. We're backing Ukraine. Your EU's backing Ukraine, so it's a proxy war. So I don't know exactly how much like it actually, I think we've spent $400 billion or something like that on the Ukrainian conflict.
Yeah.
But our annual budget is almost $1 trillion for defense. So the thing that a lot of people don't understand about our inflation is that so much of it, and our unemployment, so much of it is government fueled. Is that government spending has been the thing that has been completely buoying a large part of this market. And also, I think I read a statistic that like 60 some percent of new hires was in government for whatever. And like the private sector is not hiring nearly as much as the government was. And I think that was the big effort when Trump went in, is that they were going to try to pull back a lot of these workforces.
Well, I think what's really important is, just last week we had the Fed Reserve meeting, right? And the Fed chairman, Jerome Powell, actually came out and specifically stated, for those that are looking for jobs right now, it's really hard to find them.
Mm-hmm.
So if we're talking about jobs being established, and most of that, like you said, was really starting in that government sector, what's really happening in the private sector is really going to be what most of the economy is going to be feeling right now, right? Mm-hmm. And so that's the piece where we might actually start to see a little bit more leverage in terms of where the interest rates go.
Meaning they go down.
With people losing jobs or not being able to.
With people not being able to find
jobs.
Right.
Yep.
Well, and the unemployment numbers are sketchy too, just because they don't take into account. There's a lot of people that I've either stopped. Some crazy statistics about men who just aren't working and they don't get unemployment, and they're just freeloading in their parents' basement type deal. But the other thing is that a lot of the people that aren't considered unemployed, but they're working like 3 Uber and DoorDash, but it doesn't move the needle at all in the economy. Those people do not have discretionary money to go and invest in goods and services outside of what their just basic necessities are. They're just getting by. In fact, they're usually not getting by. They're the ones who are adding up to this. Are we up to $2 trillion in credit card debt yet? I'm not sure. I think we're at 1.9, which is by far the highest watermark. But
almost there.
But the thing is that's it's kind of a misleading number, because if inflation is high and the cost of goods and services is very high, then it would lend itself to that credit card debt getting accelerating at a much higher level. But again, wages have not kept up. So, but we had people over 2 weeks ago, secure jobs. They were laid off 2.5 weeks ago.
I just had a buyer onboarding on, when was this? Saturday, whatever, within the past couple of days. And, talking to them, I'm like, so what I do at buyer consults, I do walk through the key points of an agreement of sale, so that the first time they're seeing it isn't when I need it back. And I got down to mortgage contingency area. And I said, I know that there are some people who say and feel so confident that oh yeah, well, our loan would never fall through. It's not like we would ever lose our jobs. I feel secure. I'm going to waive the mortgage contingency because I know it's going to go through regardless. And I'm like, that's not me. Unless you have cash to be able to purchase the home with cash, I will always, 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 always be electing this mortgage contingency, and will never waive it, because you never know what's going to happen to your job. And if you lose your job while you're under contract and you waived that mortgage contingency, I don't want you to be in that position, because it is just so it's seemingly random of people being laid off at a moment's notice.
I think that there will be more. If the market does slow, that the people who usually will get laid off are the salespeople, There's a constriction of sales force when there's just not as much to be sold.
Sales and marketing.
They're not taking as many meetings. They're being told by their vendors, we don't have the budget this year, guys, that type of thing. They will offload those like base salaries. Usually salespeople will have base plus commission. They'll just offload those people because they're easy to offload. So I haven't seen like a major shift in unemployment, but I just don't buy the numbers. I think there's a big incentive for the government to keep those numbers where they need to be, which is around that 4%. But it's not really accurate, I think. And I think that also lends itself to some of the resentment. Like people are, they just see all these government officials and the media talking about how great the economy is. And everyone's like looking around like, well, where is this economy awesome for, and I think it builds resentment, and so we always just try to shoot everybody straight. And that's why Megan is one of our preferred partners, because we don't bullshit, and just like Jen said, like we don't let, unless it's extenuating circumstances, we don't let people just be reckless with their offer. And we always want to be cautious with what we're doing. But
it's why we work with Megan, because Megan also follows the same philosophy of she doesn't let people lend recklessly either, or borrow recklessly, I guess you should say.
I think it's important. We've got to find like what that comfort range is, and also being able to share that with clients, not just because that's what I can determine on what I look at from your gross income and your take home pay, but realistically, how does it feel to you when you are buying this house?
Like, how do you want to live after you have this house?
And what are the levers you can pull that can make it more affordable? If this is where your salary is, can you do something like house hacking? Can you have roommates that are coming in, right? There's properties where you could purchase a duplex and it could be 3.5% down. So what can you do to make something affordable if your goal is home ownership? But it can't just be my goal is home ownership because I just want to own that asset. You've got to have a bigger picture of it right now, because it's not super affordable and it doesn't feel easy, right? Buying a home right now has to really be a strong decision, because you know that you're owning something that really matters, right? To your financial security, your stability, and then to really be able to build wealth long term. Because when we talk about real estate as an asset class in comparison to stocks and in comparison to bonds, it's a really strong, stable asset class.
Yeah, well, it's panic proof, stocks.
Well, I think that brings it all back to, I mean, if you're talking panic proof, and we are literally living in a time of panic, I mean, so it all goes back to what the ultimate question for Megan is this still a safe time to buy with all of this uncertainty and panic going on? And I'm pretty sure it kind of just rounds it all out to say, yeah.
If you can afford it, if you can make it work for your lifestyle, and if you understand the importance of owning a home for you, then yes, it makes total sense. But it shouldn't just create this massive fear of, do I do this right now because the world's going to come to an end? How likely is that really to happen, right? The question is really more along the lines of, do you have the ability to afford it in what feels comfortable for you and not what the media is telling you?
And if not right now, then how and when? And it's not that like, I mean, somebody might not be able to right now. And it's something that Seth and I talk about a lot with this whole, we talk about kind of like this whole tent of, there's people, very few people are ready like right now. But people tend to just get discouraged by that and not realize like, well, then let's make a plan, and that it takes longer to get ready to buy a house. You can't really like buy a house as impulsively these days. But it just takes more. It doesn't mean that it's completely unattainable. It just takes more work and more planning and more strategy. And people feel either intimidated or discouraged by talking to a lender because they feel, judged, or they don't feel like confident enough in like what they're able to do. And, I can't do this. And somebody's looking at it and putting a spotlight on it, instead of seeing hey, here's a team of people that really wants to get you there. And, it takes putting it all out on the table and just being humble about it and saying, everybody wants to help you. Let's get everything out there and create a plan for you. Because like I said, you can't do things as impulsively these days.
Like Seth said at the beginning, right? He said it's that piece of taking all of that clarity And what I always say when I'm talking with new clients is, hey, I'm going to take all the puzzle pieces. Give me all the puzzle pieces. Tell me everything that's going on, right? Let's take all those puzzle pieces. We're going to take that clarity. And then by the end of this call, you're going to have complete confidence, whether it's going to be right now, whether it's going to be in 6 months from now, whether it's going to be in a year or two from now. It doesn't matter. We want to give you the same tools so that you can figure out what's affordable and what's the right time for you. That's it.
Yeah.
I love the analogy of a puzzle too, just from every aspect. Because it's like what you need is you need the picture of the puzzle and what it's supposed to look like. And you need every single piece, because if they leave a piece out, the puzzle's never going to get finished.
Yeah.
And then everybody gets pissed off because there's that one piece missing.
Well, you guys have heard me on call say this a million times. It's like, we got two puzzles, man. We got the financial puzzle and the logistical puzzle. Financial is the lending, the money, where is it coming from, your income, debt to income, whatever. The logistical is, where's the house? When do you buy? Who's coming with you? What does it look like?
What do you need to sell?
Yeah, do you need to sell? The logistics, like movers, everything. I said, we're going to put all the pieces of the puzzle together, or all the pieces on a table as we can. When we take these two puzzles and put them all together, you're going to be sitting at a settlement table signing documents. And that's our job, is to make sure that you have a full understanding of what everything is before we get way down the road here, and we get you clarity. And then we put a plan together and get you solved. So I think it's one of the reasons we work so well together, is because we have that same philosophy. It's not rushing people out, showing people who aren't approved, overwhelming people with information. I think the word that I would say that a lot of people have, I think the emotion is apathy. People are apathetic about their chances, their prospects. It usually is spoken from somewhere else, like they don't, they're not happy with their job, they're not happy with their relationship, and they're like, well, how the hell would I ever go buy a house? That's like a completely like insurmountable thing. I can't even get my life together in certain ways either. I think that is really the crux of the matter. But I would say a majority of the people that we get on calls are pleasantly surprised at how manageable it is, even if it's not right away. It is very manageable to be like, oh, okay, we can put this plan together and I can see a light at the end of the tunnel in 6 months or 12 months. And then you have something to save towards.
And also, I mean, this could probably have potential to spiral into another 20 minutes, but it's not going to, because we wanted to be done 5 minutes ago. But there's something to say too about if you're renting, and we're talking about, this whole episode is about what happens with, if we're going to war and how that affects housing. For those who are renting, you have a landlord on the other side of this that has an income producing property. And if they need to find a way to put more money into their pockets, will this all cause rents to go up? Just because it's not like there's regulation about what they can and can't do with their own rental properties. So, it's something food for thought to think, like, do you want to roll the dice on what your landlord is going to need financially and risk your rent going up, or have financial security and knowing that your mortgage, for the most part, is what it's going to be, aside from like taxes going up or your insurance going up or whatever. But
I will add a comment to that. And it's not just about financial security, but logistical security. Landlords have jobs. Landlords lose jobs. They need to liquidate funds. You don't need a job to sell a house. You need one to buy one. But you want to know if you have housing security, look at what your landlord does. If he works at some, C-suite, W-2 high-end job or whatever, or you think that his job is going to be replaced by AI or whatever, you might get that 60-day kick-out notice and you got to move because he's selling the house because he doesn't have a job and he needs the money. So that's another thing. So that's even tenants. You should be really paying attention to this type of stuff because it's not just financial security and a hedge and an asset against uncertainty. It is still also logistical certainty, knowing that you have a house that no one can kick you out of as long as you make that payment. So I think that's a good place to leave it. This is part of what high-end lenders and realtors do, is we think about these types of things. We think about these types of scenarios so we can protect our clients, both our existing and future clients we've never met before. So Megan, I really appreciate you hopping on.
Absolutely.
Go Hounds. By the way, we just skipped over. Megan and I both went to Loyola. We had two totally different college experiences.
Same school.
Same school, but was not captain of anything.
Captain the cheerleading team.
I was
Big nerd.
Oh, you would be.
Magna cum laude.
Yeah, I was magna cum laude at business school, but not the whole thing.
Well, we're both from Philly, so go Birds.
There we go.
I was captain of the drinking team, and that was fine. But no, thank you very much, Megan, for hopping on. I will definitely have you back. I think our market is going to be an evolving one, and we will need your expertise.
Oh my gosh, would love to join again. Thanks for having me.
All right, see ya.
Bye.